Good morning and welcome to Managerial Accounting. I know this is my second welcome for today. As we look at our calendar, we just had our visit from Stacy Tanner, the relationship manager from Bellevue University. And if you are considering transfer and you're trying to figure out where might be a good fit for you, I would encourage you, if you're watching on video, to take a look at the Bellevue University recording that is in the reference materials. It's maybe a 5-minute video, and it gives you more information about how to contact her and what Bellevue has to offer, in particular for business majors. So now we're starting our actual class, and last week we finished up chapter 21. And so the chapter 21 problem should be submitted for grading by the end of today, assuming that you have finished what you need to finish and you're happy with your results. I would remind you that there is a tutorial video for that problem in the chapter 21 reference materials folder in Blackboard. So if you try the problem, if you get stuck, your first line of defense should be going to that video and then asking for assistance. We're going to be covering chapter 22 this week. Chapter 22, though, is not on the exam that is scheduled for this week. So if you are concerned about covering material that's then not going to be tested and it might interfere with your studying or recall of the 3 chapters that are on this exam, remember that you are welcome to take the exam whenever you are ready to take the exam. I would not suggest that you take it before you finish that chapter 21 problem, but anytime after that is fine. Officially, the exam window, as always, is Thursday to Sunday, but in reality, the exam's open for you now. And so you are welcome to take it today if you are ready today, if that helps you. So feel free to do that. But we will be starting chapter 22. So the chapter 22 pre-quiz should be submitted for grading by the end of the day. And then the exercises on Tuesday, the exercises on Thursday, the problem next Tuesday. We are going to be talking about the exam next, as soon as we finish going through the calendar. We do have a drop-in review session scheduled for Friday morning. All are welcome. You are welcome to come and be a fly on the wall and see what other people are asking about or what we're going over. It's totally optional. You're not required to be there at all. But if you are planning to attend, I would request that you sign up through Starfish to attend that session. I do not have a plan in place yet for Friday, but what I would suggest, what might make sense, if you haven't taken the exam, we can take a look at the chapter 21 problem. If you're still stuck on that, we can look at the practice exercises for the exam, if that would be helpful. As has been the case since I started doing those, it is totally up to whoever comes to those sessions what we cover. So please, if you think that would be beneficial, sign up for Friday. Next Friday, the 25th, I am having a virtual visit for our business program review. And I'm going to be looking for just a handful of students to take about a half hour maybe of your day, Friday morning, and meet with that team. The meeting would be on Zoom, and I'm going to reach out individually to people that I know have background and experiences that might be helpful for that. But if you think you have a good perspective on the business programs, I would encourage you to send me a note and say, hey, I'd like to be a part of that. Can you tell me a little bit more about that? So that would be on Friday, March 25th. It will be mid-morning. I don't have the schedule in front of me, but my Spidey sense is telling me it's something like 10 or 10:30 for about a half hour. And there may be some reward for doing that, not extra credit, although we could talk about that if that's what you would prefer. But what I'm thinking is like an Amazon gift card of a small denomination. So it's not being paid, it's just an incentive to participate. Okay. Any questions about the calendar? So the reason I mentioned that specifically about the 25th is I haven't yet nailed down a time for a review session that week, because I may not be available on the 25th. I'll have availability here and there, but maybe not for a solid hour, because I will have this virtual external team visit. All right, if there aren't any questions, reminder, the exam and the exam extra credit are due in Cengage See Now before the end of the day on Sunday. So you should be planning for that. Don't forget to open your ebook before you start the exam. And so what I want to look at next is the exam itself, just so that people are comfortable, there aren't any surprises. So the exam, as you know, covers 3 chapters, 19, 20, 21. You can see there are a total of 26 questions. I think that might be fewer questions than there were on the previous exam, because this covers only 3 chapters rather than 4. As always, there's a mix of exercises and multiple choice. Most of the multiple choice are designed so you can read the question, choose the correct answer. Of course, the ones that are exercises are going to require that you do some math, some accounting on the side to find the answer. So that's the exam, multiple choice exercises, 3 chapters. So there are, I can get to them. There are practice exercises, as there have been for every exam. So there are 12 practice exercises and only 26 questions on the exam. So my suggestion would be, if you try the practice exercises, if you're comfortable with them, if you're able to finish these exercises, that you're pretty well set up for the test, because you know that these exercises were chosen after I made the exam. So these exercises specifically, they're not clearly not the same question, but they are chosen specifically because they're similar to something on the exam. So I would, of course, encourage you to work your way through the practice exercises before you take the exam, but it's totally optional. And some of you may not do that. All of the exercises have the check my work button. Some of them also have the show me how, which may be helpful. You are welcome to ask me questions, schedule time with me to go through any or all of these. As I said, maybe Friday morning at that review session, we could take a look at some of these. I happened to pick, just trying to find one with the show me how button, I happened to land on the reciprocal services method. Remember, that is not on the exam. It is the extra credit. So if you are not a fan of algebra and you're afraid of, not afraid, that's not the right word. You don't want to practice things that you know aren't on the exam. This would be the one exercise in the practice set that I would say you could skip over, because this reciprocal services method of allocating support department costs, I already told you, is not on the exam. But it is the extra credit. So any questions about that, about the exam or about the practice set, anything like that? Any questions from any of the 3 chapters that are on the exam? Before we start the new chapter that is not on the exam, I want to make sure everybody's comfortable with where we are. So we've got support department allocation and joint cost allocation in Chapter 19. We have the CVP method, cost volume profit analysis, and the high-low method in Chapter 20. And then Chapter 21 that we just finished is absorption and variable costing. All right. Well, since there do not appear to be any questions, I'm going to pull up my Chapter 22 exercises, and I would ask that you do the same. We'll be getting to those in just a moment. And we will go to our new chapter. If you recall, a couple weeks ago, I told you that Chapter 20 on cost volume profit analysis is probably my most favorite chapter of all the chapters we covered this semester. This chapter might be my least favorite, not because it's not beneficial, not because it's not important. Interestingly, budgeting is the one thing that I have said since most of you started financial accounting with me, is something that regardless of where you work and what field you go into, even if it's totally not business, even if you, as Stacy mentioned this morning, were to change your trajectory and go into human service, you are still going to see budgets. So budgets, this piece of accounting, is the piece that's the most widely applicable. So that's kind of contradictory that I told you 2 weeks ago, CVP was my favorite because it's so helpful and so clear to see how it can be useful in business. And then I turn around and tell you, yeah, but I don't like this chapter, which is even more ingrained in our everyday life. So I apologize in advance. It's not my favorite chapter because to me, it just seems so clear cut, so intuitive, and it's not as, I don't want to say that budgeting isn't complicated, budgeting isn't, an intricate being, because it certainly is. I can't even give you any more description than that of why this is just not my favorite chapter. And I probably should never start out a chapter like that. And yeah, this isn't going to be any fun. But if you've had me, all of you have had me in class now for at least 8 weeks, and most of you have had me for 23 weeks so far. So you probably get that there are parts of accounting that I think are really fun and really, really beneficial and I enjoy, and this is just not one of them. So we have our 6 learning objectives here. We're going to start out with what budgeting is and why it's useful. We will talk about the different elements of the budget process, different types of budgeting, so that you're familiar with the terminology. And then the majority of our exercises for this chapter will be actually producing operating budgets and then financial budgets at the end of the chapter. I think everyone knows what a budget is, right? It's kind of a roadmap for where we're going in the future. As I have said, and starting in beginning of financial accounting, and repeated a moment ago, I don't know of a single organization that does not have a budget. They may not do a great job of budgeting, they may not do a great job of follow-up that we'll be talking about, but every organization should have a budget, and I would venture to say that most all of them do have a budget of some form. And that is why I think everyone should have a sense of what accounting is, because accounting is responsible for producing those budgets. We'll be talking about where the information comes from, who provides that, but accounting is ultimately responsible for packaging that budget together in a way that makes sense from a financial standpoint. So what do we do in budgeting? Well, one of the differences between financial and managerial accounting is that managerial accounting is prospective. It's forward-looking. There's nowhere that is more clear than in a budget, because a budget is not about what happened last year. It's about what we think is going to happen next year or over the next 2 years or something like that. Budgeting starts with establishing goals. And by goals, I don't mean here's what we hope happens, but here's what we believe will happen. Here's what we are shooting for to happen. Here's what we plan to have happen in our business. Absolutely prospective or forward-looking. And that's the part that I would venture to say every organization has, large or small, one-man operation, or 20,000 employees in your corporation. There's some kind of a budget. It's the next two steps that you see here on the slide that some organizations may not do a great job of implementing, which is the follow-through. Okay, we've set our budgets. Here's what we want to have happen. Here's what we believe will happen. But then there may not be a clear plan to implement the budget, to drive the corporation or the business, the organization toward those goals. And then the absolutely imperative part is we have to be retrospective throughout the process, which is, here's the goals we set, here's our budget. How did we do compared to that budget? And if we didn't hit our goals, why not? And we have a chapter coming up, and it may be the next chapter. I'm just going to confirm. Yep, it is the very next chapter. So the chapter we will cover next week is on analyzing variances. And that really comes back to this third step, which is, here's the budget, here's what we wanted to have happen, here's what actually happened. Why are these numbers different? And sometimes the differences could be positive, and in a favorable light, like we saved money or our revenues were higher than we expected, than we budgeted. Sometimes they might be negative variances or unfavorable variances. We spent more than we planned to, or our revenues didn't hit our goals, did not reach those budgeted numbers. Either way, favorable or unfavorable, it is important to the process that we do this third step. Compare what actually happened to what we wanted to happen or what we budgeted for. And then the next step beyond that is, okay, these numbers weren't the same, why not, and what do we do about it? So it's not even enough to recognize there are variances. You have to figure out, how do we fix this when it's an unfavorable variance, or how do we make this happen again if it's a favorable variance? So budgeting really involves all of those steps. It's not just setting the goals up front, but then seeing how did we do compared to those goals, and what do we do about the misses. Just to see these terms, so what we just talked about is planning in the first phase, setting those goals, setting the budget down on paper or in our accounting records, directing the activity of the business to try to achieve those goals, and then figure out how to make it better when we don't hit our goals. You'll notice right here in the center of the screen in that blue writing, the term responsibility center. I brought that up, I think, in our last chapter, definitely in one of the recent chapters. I talked about responsibility centers and only holding management accountable for the costs that come under their direct control. In an upcoming chapter, we'll talk more about that responsibility accounting. But it is important when we're putting a budget together that we are then going to try to implement and gather data to see how did we do, that we are only including in the operating budgets for a specific department or manager, work cell, whatever, that we're only including in that work cell, in that budget, in that part of the operating budget, the revenues and costs that come under the control of that manager. It's not appropriate, I don't like this word, but it's not fair to hold a manager responsible for something that he or she cannot control. And so you can see that this is a feedback loop. It is an iterative process. That means it happens over and over in this loop. And it is not something that we do the planning, then we do the directing, then we do the controlling, and then we start over again. We are constantly doing all three of these things. So I'll give you an example. At JCC, which for the last 19 years of my life has been where I've been working. And so at JCC right now, we are obviously directing for the spring semester 2022. We are planning for next year, putting together our master course schedule. Advisement will start in April. For those of you who will be returning to JCC next semester, you'll hear me talk more about that in class in a couple weeks. So we have a spring break, a 1 week off at Easter in April. We come back to campus on April 18th, and that is the start of advisement and registration for most students. If you are a military veteran or if you are a member of the honors program at JCC, you will be able to register the week before break. For those of you who may be my advisees, I will also likely be doing some advisement over the break just to make sure that everybody has time to fit in. So for some of you, it might be easier to get that done during the break when you don't have classes and other obligations. So we are planning for next year. We are directing the current semester. And at the same time, we're still looking at what happened last year, last academic year, but also in the fall, and comparing our results to what we planned or what we budgeted. So this is a constantly kind of rolling forward. We're doing all three of these functions related to budgeting at the same time, but for different time periods. Questions so far? So you've probably heard the term SMART goal. You may have even heard it from me before in another context. We want to make sure that our budgetary goals make sense, that they follow the guidelines of SMART goal setting, that they are specific, measurable, attainable, realistic, and time-based. So we want to make sure that we're not setting them so high that people throw their hands up and say, that's not realistic, that can never happen. But we don't want them to be so low that we're giving up some opportunity to improve our organization. And we also want to make sure that our budget is a coherent whole, that we are not saying at the same time that we want to cut costs but increase revenues when those two goals may be in conflict. It is not uncommon, but not a good plan, to build in some padding in the budget, referred to as budgetary slack, to make sure that we are able to attain our goals. Now, I'm not saying we shouldn't be realistic and that we shouldn't plan for any negative events, but to intentionally inflate the budgetary numbers to create those too low goals, as we just saw in that last visual, means that we are building in inefficiency. We are encouraging our employees, our managers, not to be as efficient and, in the case of a corporation like we're discussing, to be as profitable as possible within those parameters. For most organizations, their budget is going to be an annual budget based on their fiscal year. But then we need to break that down into smaller time frames, smaller chunks. As we said back in chapter 15 at the beginning of the semester, one of the differences between financial accounting and managerial accounting is the intended audience. So for financial accounting, those are external reports. They need to be general purpose by definition so that they can meet the needs of a wide range of decision makers that do not work for the company. Managerial accounting, which of course includes budgeting, is designed for an internal audience, but just like those external audiences, there are different levels of, or different types of individuals who are trying to make decisions about the company. For example, the board of directors doesn't want to see production numbers for Tuesday. They want to see and approve, part of their job is to approve the budgets that are for the whole year for the entire operation. So they're looking at more of a macro level. While the supervisor on Tuesday's second shift does need to know, how much are we supposed to produce on Tuesday? How much are we supposed to produce for the week? How much are we supposed to produce for the month? So we're going to have this macro level annual budget, the master budget, that encompasses the entire organization for that fiscal year, for that operating period. But we're going to need to break that down into smaller, more manageable units. Think back to that responsibility center, the responsibility accounting that I mentioned. We need to tell each individual manager, here's your part in this. Here's what you need to do. Here's what you need to do for the year, for the month, for the quarter, the week, the day, and so on. Although most organizations are going to have an annual budget based on their fiscal year, they may also do what's called a rolling budget or continuous budget, where they're constantly, as 1 month passes, they're tacking another month on so that they're constantly having this 12-month forecast of where do we think we're going to be 12 months from now. And you can imagine how that would be helpful. If you are an organization that budgets by the year, and we're going to say it's the calendar year. So if we budget for the calendar year and it gets to be November or December and you don't know what the budget looks like for next year, it can interfere with that long range planning. And so having that continuous or rolling budget, we'll see an example of that here on the screen, if we have this continuous or rolling budget, we are constantly looking at the horizon, looking 12 months out and saying, okay, where do we need to be 12 months from now? It's a little bit more fluid rather than looking at things in artificial time periods based on our calendar, based on our fiscal year. So it does help us to be better planners. Most organizations are going to have a budget committee that is responsible for the ultimate production of that budget. It is usually a good idea to have one person, which may be the controller or the CFO, depending on the organization, the accounting manager, who is going to be the head or the ultimate responsibility or authority as it comes to that budget. A couple different ways of budgeting though, and we'll put some terms on the screen at this point. Authoritative compared to participative. Some organizations, this is more what I would call old school budgeting, although it's certainly possible. There are businesses who are organizations who are still doing this today, and that there are businesses from 50 years ago who did not follow this process. But I think of authoritative budgeting as the old school budgeting. The accountants went into the back room, they put on their little green shades to protect their eyes. And if you don't know what I'm talking about, look at a picture from of accountants from 50 years ago or more. And they put their heads together and they cobbled together a budget that met the ultimate goals that they were looking for. Maybe that's a certain level of profit or a certain level of activity within the business. And then they came out of the back room and they said, here it is. Here's your budget, make it happen. That's authoritative or top-down budgeting. So what are the problems with that? Well, we are human beings, and for many of us, the first reaction when someone says you have to make this work is, no, I don't. That's not going to work. Who came up with these numbers? You didn't ask me. I can't do this. The alternative is participative budgeting, and that's what I'm going to suggest is a much more effective, much more likely to be realizable in your budgeting process. And that is, you seek the input of the people that are going to be expected to implement that budget. You go to them and you may say, hey, this is what we're trying to achieve. Tell me how this can work in your department. But you get their input. You don't impose it on them. You get their buy-in because you've asked for their opinion, or their input to the process. I am not suggesting that we let everyone set their own budget, because that would certainly lead to a lack of coherence among the various pieces of the budget. It makes it more likely that we're going to be setting those loose goals that we saw a few minutes ago. And so I'm just suggesting that we get their input, that we get their buy-in, that we give them an opportunity to say, this will work or this will not work, and here's why, and here's what we can do instead. That's participative budgeting, and it's much more likely to yield a result that makes everybody happy and actually works. On to our next concept. I want to just go to the next page. Oh, no, can't do that. So zero-based budgeting means we start fresh every year. This is contrasted with the way many companies and most government bodies do their budgeting, which is we start with, what did we have last year? Okay, we need more than that. And what kind of an increase are we going to get? The concept of zero-based budgeting is not used in government, and you can tell that one specific way. When you hear reporting that says there's going to be a cut to Medicare next year, or there's going to be a cut to name your government program, and then you look at the numbers and see, yeah, but they're spending more than they did last year. How can we call that a cut? It's because they don't use zero-based budgeting, because they look at last year's and they say, we're going to give you a 4% increase. Oh no, let's make it 3%. And that's how they define it as a cut. Very rarely do you see actually less money being spent than last year. And so what happens when you don't use zero-based budgeting? I'll come back to what zero-based budgeting is in a moment. When you use the more common approach, when you say, okay, your department's budget last year was $100,000. We'll start you with $100,000, but how much more do you need? It encourages waste. It encourages behavior like, ooh, our budget year is running out and we haven't spent all of that money yet. We better go out and spend it on things we don't actually need or want, because if we don't spend it, we will lose it. So 2 different approaches there in the more common approach described here in this second open bullet point. It could be that we start with last year's budget numbers. It could be that we start with last year's actual expenses. Starting with last year's budget numbers may even be more dangerous, because as I said, it encourages people to spend. Because it's in the budget, we have to spend it. Because if we don't use it or lose it, if we don't spend it, they won't give it to us next year. Zero-based budgeting, on the other hand, although much more challenging, is probably a better way of budgeting, of managing expenses, because what you do is you start from zero, hence the name zero-based budgeting. You start from zero, and your department or whatever unit you're budgeting has to justify every piece of their budget. It's not because we had it last year, it's because we need it this year. And here's the justification for why. So many organizations do not use zero-based budgeting. The organizations that I have been involved with in terms of not-for-profits generally start with, what did we do last year? And we look at, here's our budget from last year. Here's what we actually did last year. What do we think is realistic for next year? So that's how most organizations do it, but it doesn't necessarily result in the best information, the best budget for the organization. It may result in waste or lack of efficiency. Our first exercise for today is going to be related to this concept that we have next. A static budget compared to a flexible budget. A static budget is basically a one-size-fits-all. Here's what we are going to do this year, regardless of our activity level. So we've talked in the last couple chapters about the concept of the relevant operating range. That most companies don't start out with we are going to make 14,100 widgets. Instead, they say, we'll probably make between 13 and 15,000 widgets or something like that. They define their parameters. We think we're going to be in this range. Well, as we've been talking since chapter 20 about fixed versus variable costs, what does that tell us? Well, within that relevant operating range, the fixed costs should remain the same, but our variable costs would be different if we produce 13,000 rather than 15,000. And they're going to vary in a predictable fashion between those two extremes of that relevant operating range. A static budget has just one number. Here's what we expect to spend for A. Here's what we expect to spend for B. Here's what we expect to spend for C, without taking into account the relevant operating range, or the fact that if we identify one sales number and we miss it, over or under, if we don't hit exactly those sales, we already know that some of those costs, the variable costs, are going to change. If our sales numbers change, if our production numbers change, we know that those variable costs are going to change. But if we use a static budget, we don't include that knowledge that we have in the budget. And again, it can lead us to make poor decisions because we aren't recognizing, oh, our variable costs went up because we produced more. Why did we produce more? Because we had more sales than we anticipated. Instead, it may lead us to going to that department manager and say, why did you spend so much money? You went over budget on this, this, and this. And the response is, yeah, because we produced more than we had planned to produce. And isn't that a good thing when you're producing for sales? And so that's enough of me talking. We're going to go to our first exercise for today, which relates to this concept of a static budget versus a flexible budget. A flexible budget does take into account when our activity level changes. Okay, so here's an example of a static budget. We are budgeting $40,000 for direct labor, and nowhere in here does it say, this is the direct labor if we produce X number of units. This is the budget that we're handing the assembly department. You have $40,000 to spend on direct labor. Do we want them to spend $40,000 if our production is half of what we anticipated? No, that would be wasteful. If we double production, do we think they're still going to be held to that? Should they still be held to that $40,000 in direct labor? I would say no. We know it's a variable cost. If we produce more than planned, those costs are going to go up. And so this would be a more appropriate version of that same budget. This is a flexible budget where we have built in, I like to think of this as a best case, worst case, and likely scenario. So what we have here on row 5 of this spreadsheet clip is what I would define as the relevant operating range. We expect to make between 8 and 10,000 units of whatever it is we're assembling in this department. We think we're going to make 9,000 units, but we might make as few as 8 and as many as 10. And so this gives us a place to start. And from this, we can develop a flexible budget formula, which is a quick and simple algebraic expression of what do we have here. What you'll notice is that the fixed costs, as you would expect, remain the same across our relevant operating range. We don't expect those to go up or go down. If we only produce 8,000 units, our fixed costs are not going to go down. However, if we produce 10,000 units, our variable costs will go up from what they would be at 8,000 units. You will notice, go back a couple slides here, they had budgeted $5,000 for electric power in that static budget. When we go to the flexible budget, you notice they have split that out. It is a mixed cost. We do normally think of electricity or utilities as mixed costs. And they have split out the part that is fixed, the $1,000, and then the part that is variable based on our level of production. Any questions before we go to our first exercise for today? All right, well, let's do that. This is our first exercise for Chapter 22, Static Budget versus Flexible Budget. The production supervisor of the machining department for Hagerstown Company agreed to the following monthly static budget for the upcoming year. So I just want to point out this term agreed to. So at some level, they have done participative budgeting. They went to the production supervisor. Now, ideally, hopefully, that supervisor was asked in advance, what do you need to make your department run this year? Here's what we think we're going to produce. What do you need to make that happen? Now, I want to make one other observation before we get into this exercise. And the question is, where does the budgeting process start? So we have here on the screen in this question, the production supervisor agreed to this budget. Did we start with the budget for the machining department? Did we start with the budget for administration or the CEO's office? Did we start with the budget for direct materials? Where do we even start? Well, with what we've been talking about, what has come up in the last couple chapters is the idea of pull-through production. So you've heard me use that term multiple times now in more than one chapter. Pull-through production. And the idea of pull-through production is we produce because we have a sale, because we have a customer who wants that product. This is not a case like Field of Dreams. If we build it, they will come. Let's just produce it and hope that someone buys it. Instead, we produce because we have an order or anticipation of an order at the end of the day. The order triggers that production. And so if we are following that very appropriate business practice of pull-through production, what does that tell us about where the budgeting process starts? It starts with sales. Starts with sales. We produce because we can sell it. So if we start with sales, that means we're talking with our sales department. How much do you think we can sell this year? Part of that is going to be based on, well, how much are we charging for the product? Because those of you who know anything about economics recognize that price is a main determinant of how much the customer is going to demand. There are other determinants, of course, but the quantity that customers are willing to buy is based on the price we're going to charge them. And all else equal, the higher the price, the lower the quantity that they're going to be willing to buy. So we go to our sales department at the beginning of this budgeting process and say, we're looking at 2023, fiscal year 2023. How much do you think we're going to sell? And they lay it out for us, the sales department. We think we're going to sell X number of this product at this price and Y number of that product at the other price. And from there, we can follow through the rest of the budgeting process. We have to know how much we're going to sell before we know how much we need to produce. We have to know how much we need to produce to support those sales before we know how much direct labor, direct materials we need. Now, I realize there are some fixed costs that are going to be the same regardless of our level of production. But at the same time that we can be budgeting for those fixed costs, if our circumstances, our conditions are changing, we're going to be looking down the road. Remember the concept that everything is flexible in the long run. Everything is variable in the long run. And so if we have fixed costs that we don't need, we would be looking at offloading some of those fixed costs. And maybe that means closing down a building. Maybe that means selling off some equipment that we don't need, or allowing our workforce to shrink due to attrition. So people naturally leave the workforce due to retirements or choosing to go to another organization or something like that. If we see that coming down the road, then we might be looking at, maybe we shouldn't be replacing Joe who retired. Okay, so we start with sales. Once we have the sales number, then we look at the production budget. And in this exercise, as we can see, we are told that the production supervisor agreed to this budget. We have wages, utilities, and depreciation. We think about what we know about fixed and variable costs. We expect that that depreciation is a fixed cost, that the wages are a variable cost, and it may be that the utilities is a mixed cost, or it may be treated as a fully variable cost. The actual amount spent and the actual units produced in the first 3 months in the machining department were as follows. So here's our total dollars spent. Here are our units produced. The machining department supervisor has been very pleased with this performance because he's looking at a static budget, and he agreed to a budget of $2,358,000. And the first 3 months of this fiscal year, his total expenditures were less than the static budget amount. So he's pretty happy about that. He or she, I don't know that it specifies. The plant manager believes that the budget should not remain fixed for every month, but should flex or adjust to the volume of work that is produced in the machining department. So what that manager has just recognized is, yeah, it looks pretty good for these 3 months, but what would happen if we produced 60,000 units or 64,000 units and our our variable costs continue to increase? As the units produced goes up, our amount spent goes up. We assume that the depreciation is remaining the same, but that the variable costs of wages and possibly utilities are varying. And so if we continue to produce more, the manager recognizes that might present a problem for us, because even though we look pretty good based on the static budget for these first 3 months, that may not continue as the company grows. So we are given some additional information about those variable costs. Wages per hour, utility cost per direct labor hour, how much it takes to produce each unit. Oh, and here is the important information, important for us right now. Planned monthly unit production. This budget was based on producing 60,000 units. And they have not yet come close to producing 60,000 units. But they're getting closer every month. And that explains why the production man or the plant manager has, the plant manager says, wait a minute, we might have a little problem here. Because yes, we've been under budget for 3 months because we haven't been hitting our plan for the number of units produced. So that's what we're going to be doing in part A, is producing a flexible budget. What if we produce 40? What if we produce 48? What if we produce 52? Ideally, this flexible budget should include what if we produce 60? But we already know right here, we already know what if we produce 60, because that's what that budget was based on. And now they're going to take into account, yeah, but we aren't hitting our planned production goals. Okay, so what we're asked to do then is prepare a flexible budget for the actual units produced for those 3 months. Assume depreciation is a fixed cost. So what we are being told is with that is that the utilities are completely variable. Now we know in reality the utilities are likely to be a mixed cost, but we're simplifying it for our purposes for this exercise. We are assuming that the utilities are completely variable. And so as we look at our flexible budget for those first 3 months, for the first quarter of the year, we know we're going to be including wages, utilities, and depreciation. We're given room down here to fill in those values in that actual budget. So this is the supporting documentation. We can fill in the depreciation part already. We don't have to do any calculations for that because depreciation, we're told, is a fixed amount, and that is here $36,000. But the wages and utilities are going to take some calculations. So we have 3 different levels of production. As I suggested, if this were a budget for going forward, we would want to include the high and low, the maximum minimum of our expected operating range, and then in the center would be that 60,000 that we expect to produce. We are told that each unit takes 1.5 hours of direct labor. And so if we produce 40,000 units at 1.5 hours per unit, we would need 60 hours of production time, right? This is where using Drew's spreadsheet would be very helpful because we can just plug this in and drag the formulas across. I'm not doing that, but if you find it more useful to use a spreadsheet, an Excel spreadsheet, so that you can use formulas and cell references, and then just bring your data into this exercise, you should feel free to do that. And so to produce 40,000 units, each one taking an 1.5 hour budget of direct labor time, our total production hours would be 60,000, and the wages per hour, $25. Our total wages, if we produce 40,000 units, would be $1.5 million. And then we can bring that number up to our flexible budget. To finish up the 40,000, then we also need the utilities, 60,000 hours of production, and the utility cost is 80 cents per hour. And that would be $48,000 for utilities. So now we can pull in our totals. $1.5 million for wages, plus 48,000 for utilities, and 36,000 for depreciation, is a total of $1,584,000. As we go down to Part B then, the flexible budget for our production of 40,000 units in May, if we had used a flexible budget rather than that static budget we had up at the top, whoops, a couple too many zeros there. Our flexible budget would have been $1,584,000. And if we go back to the information given at the top, we can see in May they actually spent $1,600,000. And so the plant manager was correct to be concerned about the use of a static budget, because the production supervisor for the assembly department, I suppose, right? The machining department. So the production supervisor for the machining department was saying, I deserve a bonus. You gave me a budget of about $2.4 million. I spent 1.6. I did a great job. We did a great job of controlling costs in the machining department. And it turns out the great job was based on the fact that production was only 2/3 of what was planned or projected, 60,000 units. They only produced 40,000. And so when we use a flexible budget rather than a static budget, it helps us to take into account that varying level of production and to reward cost savings, or, and I don't want to use the word punish, but address cost overruns as appropriate. They had a cost overrun in May. They spent more than they should have on running the machining department in the month of May. If we had known they were going to produce only 40,000 units, our budget would have been $1,584,000. Everybody okay with that? Comfortable with that? Okay. What I would like to do then is pause the recording, allow you to do the calculations for the next 2 levels, and then restart the recording if you're watching on video. So finish up Part A and Part B for June and July, and then restart the recording. Okay, so we can now look at our completed flexible budget for the 3 months ending July 31st, the first quarter of the fiscal year for this company. So we have our totals across the bottom, our supporting calculations, and if we go down to the analysis, so this is what's happening in the final phase of that cycle, where we plan and then we direct and then we control. And in the controlling phase, we're going to look at what did we say we should spend, what did we actually spend, what's the difference. You'll notice the heading on the 3rd line is excess of actual cost over budget. And so for July, when our actual cost was less than budget, I'm showing that as a negative because that's a cost savings. July is the only month that the machining department outperformed the the flexible budget. So what does this comparison suggest? Then the machining department has performed better than originally thought? No. Because the department is spending more than would be expected? Yes. Yes for May and June, not so much for July.
Actual cost for July was 2.2 million.
Oh, did I? Sorry. Oh, it sure is. Thank you. So I miscopied that. Thank you. So I take back what I said about the negative. So it's even worse than we thought. And they are spending more for each month than we had anticipated. And so as we get closer to that planned production of 60,000 units a month, we know that this could continue to get worse. Could continue to get worse. All right, any questions about the value of using a flexible budget or how we would go about that? Remember, it's important to separate out the variable from the fixed cost. We need to be able to accurately predict which of our costs are fixed and variable, just like we talked about in chapter 20 with CVP analysis. The more accurate we are with recognizing fixed and variable cost, being able to separate our mixed cost into the two pieces, the more reliable our analysis will be, the more valid, in this case, our flexible budget would be. If there aren't any questions, and we'll move on to exercise 2. So I already talked about the importance of starting with sales. And so we're going to see that as we go through these exercises. If you were just to click down through the exercises, the budgets that it says we are doing are in an order that makes sense. We start with our sales budget. Once we know how much we can sell, we know how many to produce. Once we know how many we're going to produce to support those sales, we can determine how much direct material we need and how much we need to buy. We can at the same time be calculating direct labor cost. Oh, I don't know why it keeps jumping like that. And then the factory overhead budget. Next class, we'll finish, we're not done for today, but in the next class, we'll finish up the operating budgets that we do not get to today. And then we will be moving on to our financial budgets. And so the last couple exercises deal with cash collections. Excuse me. This is related to putting together a cash budget and being able to predict our cash needs or the working capital that we need. Do we need to have access to a line of credit, for example? And then our final exercise for this chapter will be on Thursday, capital expenditures budget. And I just want to say one word about that. We'll come back to it on Thursday. Capital expenditures, buying long-term assets for most organizations is a separate budgeting process because this is really long-term planning as contrasted with our operational plans that we're doing, starting with our sales and production budget in exercise 2. So with the time we have left, we'll just start working our way through these operating budgets that support the running of our business on a day-to-day or week-to-week, month-to-month basis. Sonic Incorporated manufactures 2 models of speakers, Rumble and Thunder. Based on the following production and sales data for June, prepare a sales budget and a production budget. So we want to do participative budgeting. We have talked to our sales force and said, how much do you think we're going to sell? And they have provided us with that information. So once we know how much we need to sell, we need to also take into account what do we already have on hand and what do we want to have on hand at the end of the period. So how much we want to have on hand at the end of the period, keeping in mind that concept of pull-through production, we want to limit our inventory to what we need to support sales in the next period. And so companies may have a policy that says, for example, we want to have on hand at the end of the month 10% of the product that we expect to sell next month, or something like that. We talked about, I think last class, I was talking about Cutco here in Olean that has a busy season and a slow season. And in the slow season, they're intentionally building inventory to support sales in their busy season. And so that would also be built into this expectation of what do we want to have on hand at the end of the month. And so in some months, our production numbers, our expected production may exceed our projected sales because we're trying deliberately to build inventory. And in other months, it may be the exact opposite, that our production numbers are going to be lower than our expected sales because we've been building inventory to support those higher sales in our busy season. So let's do our sales budget. And we will start with Rumble because that's the way it is set up. So in the month of June, we expect to sell 12,000 Rumble speakers in the Midwest region and 14,000 Rumble speakers in the South region for a total of 26,000 units. As I already mentioned, our sales budget will include revenues, will include the selling price, because what price we are selling, what price we're charging for the Rumble speaker has a direct impact on our sales. So we cannot do a sales budget without knowing the price. And that is true for virtually every product out there, that there's some level of what's called elasticity or sensitivity to price. So we cannot have a sales budget, a complete sales budget that does not include the selling price. Everybody okay with the sales budget for Rumble? So you can go ahead and do the budget for Thunder. Everybody okay with the sales budget? Total revenue from sales, $2,235,000. Predicted or estimated in our budget. That number is going to help us in preparing our cash budget when we get there. It's also going to help us with preparing the income statement or the pro forma, what's called a pro forma or budgeted income statement, which is another part of the budgeting process. The operating budgets and the financial budgets make up the whole package, the master budget. You'll notice when we get down to the production budget, though, there's nothing in the production budget about dollar amounts. We don't know yet how much it's going to cost us to produce these units. The cost of goods sold, cost of goods manufactured, is going to combine the next three budgets that we produce: direct materials, direct labor, and overhead. We can't possibly include dollar amounts in the production budget because we haven't done that yet. We haven't forecasted or budgeted for that yet. So to do the production budget, we start with, if we had to pick just one number for the budget, for the production budget, the single best number would be, well, how many do we expect to sell? And you can see that for Rumble, we expect to sell 26,000, and for Thunder, we expect to sell 7,500. However, that does not take into account the expected or desired beginning and ending inventory. And so we're going to be doing a little bit of adjusting to that. We expect to sell 26,000 units of Rumble, but we also at the end of the month want to have on hand, right here, at the end of the month, we want to have on hand 500 additional units on top of what we expect to sell. So we need to have available throughout the period, not at any given time. At any given day, we probably don't have all these units on hand. But throughout the month, we need to have available a total of 26,500 units. Well, how many of those units do we expect to have at the beginning of the month? And again, that number was given up here, 750 units. So even looking at that beginning and ending targeted inventory, we knew that our production number, we should know that our production number for this month is actually going to be less than our sales. And how do we know that? Because we expect to sell some of the inventory that we had at the beginning of the month. We're going to reduce our level of inventory. Now, from an accounting standpoint, I need to remind you of something we discussed in financial accounting in chapter 6. There's a difference between the flow of cost through our accounting records and the flow of product through our actual inventory, the physical inventory itself. And for our accounting records, we make an assumption, and you may remember, these may sound familiar to you from financial accounting in the inventory chapter, which is chapter 6, regardless of whether you had me or another instructor at JCC. For financial accounting, the inventory chapter was chapter 6. And the different methods that we talked about in chapter 6 are FIFO, LIFO, and weighted average cost methods. As we talk about this sales and production and the flow of costs through our budgets, we would need to know, in part, does the company use LIFO, FIFO, or weighted average costing method for their inventory? Right now, in this exercise, we're only talking about the number of units to be produced. We're not yet, in this exercise, talking about which units did we sell, as I started to imply unintentionally. We are told here that the company expects to start the month with 750 and end the month with 500. We don't know in our accounting records if the 500 we ended with, or expect to end with, are 500 of these 750, which would be the case if we used LIFO, or if it's 500 of the brand new units that we just made this month, which would be the case if we used FIFO. So I'm just trying to make you see how all of these pieces fit together, the connections between what you learned in financial accounting, how they still impact what we're doing in this semester as well. So go ahead and finish up the production budget for Thunder, where we want to end the month with 250 and started the month, or expect to start the month with 300. So again, we're going to be selling down or working down our inventory. We expect our inventory to go down by 50 units from 300 to 250. We expect it to go down by 50 units during the month. And so our production budget is 50 units less than we expect to sell. And that's how we work that inventory down. If you're following anything with the economy right now, you may have heard the term leading and lagging indicators, and manufacturing inventories are a leading indicator. Oh, thanks, Seth. They want us to put negatives in front of, oh, it does say that. Thanks, Seth. For those boxes in which you must enter subtracted or negative numbers, you would use a minus sign. So we know that this software sometimes can be sensitive. Sometimes it will allow you to use them or not use them, but if it says to enter negative signs, we need to enter negative signs. So thank you, Seth, for pointing that out before I saw the red X's and got sad. So manufacturing inventories are a leading indicator of a coming slowdown, because the manufacturing companies continue to produce and their inventories start to rise, because they don't recognize the slowdown in sales until their inventories are starting to rise. And then when the economy is coming out of that slowdown, you need to work down those inventories. And that may possibly be what the company is doing here. They have an inventory at the beginning of the month and they're planning to bring that down slowly. And so they don't need to produce as much because they have that inventory, excess inventory to work down. But this company doesn't have a whole lot of inventory sitting around. Those numbers are pretty small. But if you're following economic reporting right now, you may hear reference to those leading and lagging indicators and the buildup of inventories, and how that means that jobs aren't being created necessarily if things start to turn around, because we still have those excess inventories to work through. I see it's 10:37. And so we don't have time to finish up this next exercise. So I think we'll stop here for today. On Thursday, we will finish up chapter 22. Don't forget about the exam. You can take that anytime after you finish the chapter 21 problem, but it should be submitted for grading no later than Sunday at midnight. Any questions before I stop the recording? All right, well, thanks for being here. Don't forget, if you want to sign up for the Friday review session, you can do that in Starfish under the courses area. If you are interested in participating in the business program review next Friday, March 25th, about a half hour of your time in the morning, just send me a note. Otherwise, I'll be reaching out to people individually to make sure we have a good mix of representation from Olean, Jamestown, online students to speak with our external team about our programs.